lot of people confuse the two. There are recessions and business cycles, and as I expect we're entering a severe recession right now. But there are also financial crises, which we've seen, 1994, the Mexican tequila crisis, 1998, the Russia long-term capital management crisis, 2008, obviously the global financial crisis, 2020. I don't quite know how to describe that. I mean, the economy goes down 31%. 31%. That's what happens when you turn off the lights, shut down the whole economy. That's what happens. So we have these financial crises, and then we have recessions. They don't always go together. 1990 was a recession with no financial crisis. 1998 was a financial crisis with no recession. The economy was doing fine through all that, even though we came within hours of shutting every market in the world. 2008 was interesting because we had both. That was a genuine deep recession, the worst since the Great Depression, and a financial crisis because we saw the sequential collapse of Bear Stearns, Fannie Mae, Freddie Mac, Lehman Brothers, AIG. Morgan Stanley was days away from going bust. Goldman was not far behind, et cetera, until the Fed came in, truncated the process, and bailed everybody out. So we just talked about how we're going into a severe recession. Mm-hmm. Is there a financial crisis on the horizon also? And the answer is yes. And you say, well, how do you know that? The signs are there. Nobody's looking, or I shouldn't say nobody. Very few people are looking, mm-hmm. Certainly not the Fed. But we see it in the Treasury yield curve. It's inverted, and just for the benefit of the listeners, a normal yield curve is upward sloping. So you have time along the x-axis, you have rates along the y-axis, and the curve of rates at different maturities goes up, and that makes sense. If sure. I'm going to, lend you money overnight, I'll have a certain rate. If I'm going to lend you money for 10 years, I might want a little more. Or you or anybody else or somebody lends me money for 10 years, you're going to want a higher interest rate because there's more risk. It's as simple as that. Well, what does it mean when the yield curve is inverted? It means that rates are projected to go lower. Mm-hmm. At longer maturity. So wait a second. Why would I take a lower rate for a longer term loan? The answer is I expect interest rates to come down generally. I'm looking for an interest rate crash, which sounds like a good thing, but it's not, because it would only happen if you had a financial crisis of some kind. So it's a long-term bet on a short-term rate. That yield curve is inverted, and that almost never happens. But the inversion starts around March 2023, where rates go up between now and then. Well, that makes sense because the Fed controls short-term rates. They've told us they're going up. We know they're going up. Just have to listen to them and believe them. But when you get out to around March 2023, they start to go down a lot. And so what does that mean? The Eurodollar market, these are the biggest players in the world. This is not your a retail account or your father's Merrill Lynch account or whatever. Mm-hmm. These are the big guys: sovereign wealth funds, hedge funds, central banks, major institutions. So it's serious money. They know what they're doing. And they're saying that rates are coming down starting in March. Again, not a good thing. Like, hey, aren't lower rates great for everybody? Well, not if it's because there's a dollar shortage, not if it's because there's a liquidity crisis. So we see, using standard economic indicators of the kind I described, inventories, real incomes are negative, they're going down. Everyone says, Jay, hey, look at the latest report from the Labor Department. Wages went up 5%. Yeah, they did, but inflation is 8%. Mm-hmm. So your real income went down 3. It's 5 minus 8 equals negative 3, at least where I went to school. So you've got declining real wages, inventory stockpile, which means no new orders, sales slowing, unemployment going up, layoff announcements almost every day. So the real economy is in terrible shape. But it looks like we might have a financial crisis on the horizon also. So it kind of is setting up like 2008, but maybe worse. And people ask me all the time, what do you do with your own money, or what's a model portfolio, et cetera. And I always explain to people, look, the key is diversification. Sure. Now, that sounds obvious, like, oh yeah, diversification, right. But the people don't really understand what it means. I'll run into people and they say, hey, I'm diversified. I've got 50 different stocks in 10 different sectors, consumer non-durables, technology, semiconductors, mining, minerals, et cetera. And I say to them, you're not diversified. You may have 50 stocks, but you have one asset class, which is equities. Mm-hmm. And they're all going to go up together, or they're all going to go down together. Not every single stock, but by and large, they're highly correlated. Real diversification, have a slice of stocks by all means. Have a slice of treasury notes, and I agree with you. I think 10-year treasury notes at 4.1% yield to maturity, I would say shoot them in, because if the yield curve signals and the economic signals I'm describing play out, and they are playing out, those yields are going to come down a lot. I know they've run up for the last 4 months. I get it. But they're about to turn around and come down a lot. So you'll get very significant capital gains on that. Plus, it's, there's no credit risk or almost no credit risk. I'd have a big slice of cash, and people go, well, what good is cash? There's a low yield and all that. Well, the answer is, yeah, it has a low yield, but you're not going to lose anything. First of all, it'll preserve wealth. Secondly, it could be your best performing asset in deflation because the real value of cash goes up. Most importantly, it gives you optionality, which means that if everything's crashing and burning around you and you're the one with cash, you can go shopping. You can pick up the bargains. And a good example is, probably no better example, Warren Buffett, Berkshire Hathaway. They have over $130 billion of cash or cash equivalents on their balance sheet. Now, why do they have $130 billion of cash? Because they see what I see. They see what's coming, and they want to be the winners who, as I say, go out and buy pick through the wreckage and pick up some diamonds in the rough. Then, yeah, real estate, absolutely. Not commercial. We're not past there's a big transition going on in commercial. It's very tricky ground, but residential, agricultural, natural resources, definitely have some gold. I recommend a 10% slice. People, Jay, they always want to put words in your mouth. They go, Jim Rickards says, sell everything and buy gold. I never said that. I don't think that's a good idea. But 10%, yeah, I do think 10% is a good idea. That's your inflation protection. It'll also preserve wealth. And by the way, I forgot to mention, cash reduces the volatility. It's the opposite of leverage. The leverage increases volatility. You can get bigger returns, but you can also have bigger losses. Cash reduces volatility. So if you've got other volatile assets like stocks, and gold and notes and so forth, the overall portfolio volatility is reduced by a slice of cash. So that's real diversification. That's what I recommend. So we haven't really felt the impact of the rate hikes that started last March, but they're still going. They are going to, raise again in December. You can debate whether it's 75 basis points or 50. We'll know when we get closer to the date, and probably again on February 1st, which is the next meeting, and maybe after that. So the short answer, Jay, is yes, they are going to continue raising rates. They're fixated on inflation. It will come down, but at a very, very high cost. And meanwhile, when maybe you should be easing up a little bit or at least pausing, they're not. And so they're going to take a bad situation and make it worse.
How does gold perform in a market like this? Not so good, you would think. What are your thoughts?
Well, the numbers are that since March of 2022, in March of 2022, not long after the outbreak of the war in Ukraine, gold, it wasn't the all-time high, but it was close. It was about $2,043 an ounce. Prior to that, gold hit $2,069, the year before. So since then, it's down about 25%. What happened? Where's the inflation protection you talked about, et cetera? And there are a couple of answers to that. First of all, gold is down 25% in dollars, but the stock market's down between, closer to 30%. So at least gold has outperformed stocks. But the reason gold is not soaring in an inflationary environment is because what I mentioned earlier, this inflation is coming from the supply side, not the demand side. They're two entirely different kinds of inflation. I mean, inflation means prices go up according to some index, but the source matters. So supply side inflation, it's because of the breakdown of the supply chain. So energy shortages, logistics bottlenecks, not enough truck drivers. And it was leading to price increases because, if there's a shortage of goods and inelastic demand, then people are going to bid up the price. Now the other kind of inflation is demand. So the first one, the supply, is called cost push. Second one is demand pull. This is where consumers have it in their heads. It's a psychological issue, it may be real, but it's driven by psychology. The prices are going up. I better go out and buy stuff right away. So you're thinking of buying a car, a refrigerator, or a new sofa, whatever it is. Better go buy it today because if I wait 3 months, the price is going to be higher. But that's self-fulfilling because if everybody does that, then all of a sudden there's no more furniture or new cars or whatever it is, and the price is going up. And that's what we saw in the late 1970s. And of course, gold soared during that entire period. But the point is, the demand pull inflation, which I described, which did happen in the 1970s, which is not the case today. We don't have that today.